Greetings, everyone. Again, I'm doing these webcasts until we are out of harm's way. And we are moving out of harm's way, I believe. We're certainly seeing it from the antiviral front, Gilead. We're seeing it from the rapid development of vaccines. And we're also seeing it in the phases that President Trump released yesterday in terms of states getting back to work. Just the fact that politicians and individuals are thinking about getting back to work, that's a change, and that's good news. I also think, at least for us, this idea that the analogy to what we're experiencing right now is are the two shocks that we've seen in the last 30 years, 30, 40 years. And the analogy being that this is exogenous. So we had October of 87, the shock as portfolio insurance failed. And we had 2001, the shock on 9/11, terrorist attacks. And we had severe reactions in the stock market, but they were exogenous. And the trends in motion beforehand, in the 80s, up and away, in the early 2000s, the tech and telecom bust, those trends actually remained in motion. This time, of course, the analogy is equivalent to portfolio insurance, low vol strategies, risk parity, pretty much failed to do what they had been doing for so many years. So that was a bit of a shock to the system. And this virus became the exogenous attack. So this period is more like the two prior ones combined. And the force with which the government has reacted far surpasses anything we saw back then. And I do think the backstops are in, and they are beginning to work. Now, not all is clear. There are a few variables out in the marketplace to which we pay a lot of attention that are suggesting not quite sure yet. One of those would be credit default swaps in the consumer discretionary space, not just in the United States, but around the world. So, of course, a lot of stores are shut, and there's a lot of uncertainty about which ones will come back. So that's very understandable. Another one is the Treasury bond yield. Now, it went as low as, I believe, 35 basis points during March, then soared to about 1.25% and is now back to 60 basis points. So is this reflecting flight to safety still? Perhaps some of that. It's probably reflecting more the deflationary impact we're going to see, especially as oil prices still have not settled down. So could be a combination of flight to safety, oil prices, maybe the combination of the two. They are related to some extent. But for 90% of the world, oil prices going down is a massive tax cut, or an increase in purchasing power, in other words. And so it's on balance, not a negative thing, although of course it is going to hurt certain states here in the United States disproportionately, and certain regions of the world disproportionately as well. Short-term interest rates are fairly stable. So what this decline in long-term rates means is that the yield curve is flattening once again, although it is positive. I mean, short-term rates are in the 10 to 15 basis point range if we use 3-month Treasury bills. So, and then on the fiscal policy side, so the way I'm breaking this down as I did the last time around, monetary policy signals that are flashing in the credit markets, fiscal policy, I'll go through the markets a bit, and then I'll land at an area in the market that we think is extremely inefficiently priced. So on the fiscal policy side, we're seeing, again, the SBA program has run out of money and the administration wants to re-up. There's some wrangling between the Democrats and the Republicans. Clearly, we think that's going to get done. I don't think anyone wants to be blamed for a relapse. So we think that's going to get done. And I think that President Trump, the administration, is going to wait and see to see how well all of this is working. But if we get through into phase 1, phase 2, phase 3, and the economy seems to be recovering haltingly, I believe that President Trump will work to get a payroll tax holiday in, that for both employers and employees, so that there will be a significant incentive to get back to work quickly this year, because the holiday will end at the end of this year if they go through with it. So I think they're waiting to see if they need it, but it's there if we're getting off to a slow start. So that's fiscal policy. Monetary policy, the spigots are open. And it is interesting that this week that the Fed decided it didn't need to buy as many Treasury securities out there. So it is seeing enough in terms of credit metrics, enough metrics suggesting that the worst is over, that it can start pulling back on some of its extraordinary and extreme measures. As far as the market, I think we have gotten a few clues already from companies that have reported. So as usual, the banks were the first to report, and JP Morgan and Wells Fargo, the first two. And I listened to JP Morgan, and I thought that the underlying metrics in the report itself were terrific. I mean, they took huge reserves. They increased their reserves dramatically because they're preparing for the worst, and because I think they were accused of reacting too slowly, not anticipating the worst in 08-09. We don't think this is anything like 08-09. They're acting a lot faster. I will say I expected the stocks to go up when I saw the results and read through them. However, on the calls, the CEOs expressed a lot of caution, suggesting that they would have to take more write-offs, that we hadn't seen the worst. And it's true, the worst is going to be in the second quarter, not in the first quarter, of course. But I think that they really did put some fear into investors, bank stock investors in particular, because they were trying to decipher, what are they trying to tell us here? Are these executives, these CEOs, as fearful as or more fearful than they seemed in the beginning during 08-09? And they are that, but I don't think anyone knew exactly how bad 08-09 was going to be until Lehman failed. So when the stocks went down on that day, I was looking carefully at the rest of the market, and it was very interesting that the market didn't take its lead from the bank stocks. It continued to appreciate. Now, those stocks, the bank stocks, have stabilized here, so that's all good. We would not want to see them drop to a new low. But it was very interesting to see that decoupling. The other news we got this week one I found very interesting was from Taiwan Semiconductor. Now, Taiwan Semiconductor, TSM, in the heart of Asia, right in the middle of all the supply chains. In terms of giving guidance, first of all, it maintained its guidance pretty much for the rest of the year. So that's somewhere in the 15 to 19% roughly revenue growth for the year. They also did not change their capital spending plans. They are continuing with the plan to spend $16 to $17 billion this year. So what does that tell us? It tells us, first, that the supply chains in Asia are loosening up quite a bit. And it also tells us that the companies which are its largest customers, Apple, NVIDIA, Qualcomm, and other merchant semiconductors, they're not seeing cancellations, perhaps, in the way they might. There still seems to be a wait-and-see attitude, but I think everybody's waiting for, they're probably seeing good results online, and there will be a lot of pent-up demand when bricks and mortar open up as well. And as I have mentioned on previous calls, we believe that the supply chains were pretty clean coming into this because consumer spending was very strong, businesses were holding back. So inventories throughout the supply chain, we think, were pretty low to begin with. So that was reinforcing, probably the most reinforcing report that we saw. We've not seen that many. These companies tend to report early. We also got a report from Intuitive Surgical last night. So it's robotic surgery, and the leader. And what they're saying is China's coming back nicely for them. South Korea and Japan didn't skip a beat for them, which is interesting. That may change a little bit now that Japan has issued a national emergency. And but what they did say was at the end of the first quarter, on a run rate basis, the most severe declines were in Europe, down 35%. So run rate would mean take the March numbers on a year-over-year basis. That was down 35%. And in the US, it was down 65%. And I think in the US, all of our hospitals, watching what was going on in Italy and before that in Wuhan, they were basically marshaling all of their resources to take care of a hospital system that could be overwhelmed. So I think it was completely off the table to order anything from Intuitive Surgical or take deliveries. So I think that's the reason there. And then I will say we've seen the auto sales last week. I think I commented on them, down from 17 million roughly a year ago to 11.4 in March this year. So a severe drop off. We're also hearing that the entire auto supply chain is really in turmoil. We saw this week that Hertz, and I don't think Avis will be far behind looking at their balance sheets, they're looking to be rescued. We know that used car prices are already have been falling and probably are going to fall at an accelerated rate here. They depend on the used car market to sell their fleets into. So that's problematic. And we did some work this week and just discussed it or debated it on our brainstorm just prior to this filming this. And if you look at where the real trouble spot this time is in the financial industry and in structured finance particularly, it's in the auto sector, the auto-backed securities. We are now seeing auto delinquency rates in the United States at the highest level. They're back to where they were in 08, 09. And I think people are pretty shocked by that because the consumer has been in great shape. And this delinquency rate has been rising consistently for the past few years. And I think what's being turned upside down this time around is that the auto paper in 08, 09 was the best performing paper, except for home equity loans. The fewest defaults were in that space. And the reason was for people who did keep their jobs in 08, 09, they needed to get to work. There wasn't the ride-hailing network that we have today throughout the United States. If people commuted to their jobs, they needed their cars for the most part. And so they were going to pay their auto loans off before they paid off their mortgage loans. They were willing to default on their mortgages because they saw that banks weren't repossessing. They didn't have the capacity to repossess as many homes as were defaulting. And in fact, I think there were cases of homeowners just sending their keys in the mail as an indication that they just weren't going to pay. So this time around, it's upside down. We're in our homes. We need a home to be in as we are staying at home. And in fact, autos we're not using, and they're sitting in our garages. So I have a feeling that because the combination of that and ride hailing would suggest that auto delinquencies are going to go a lot higher. And we think they could go as higher than the mortgage loan delinquencies in 08, 09, and perhaps as high as the credit card delinquencies. In other words, the bottom line here is the auto industry is in turmoil. And I think we're going to see tremendous consolidation in the industry itself. We probably will see bankruptcies, especially as electric and then ultimately autonomous strategies start to take shape. We're seeing Tesla already taking a huge amount of share. I think their first quarter auto sales were up 40%. And as I mentioned, for March alone, the traditional auto manufacturers saw a 35% drop in their sales. So Tesla is taking market share. And believe it or not, compared to a year ago, May a year ago was when it plummeted into the 170s. Tesla has the fortress balance sheet in the auto sector. How the world has changed in just 1 year. So what I'd like to end on is the part of the market that we think is one of the most inefficiently priced parts of the market, and that is the genomic space within healthcare. And the reason it's inefficiently priced is the same reason Tesla is inefficiently priced. Analysts have to be expert at understanding the ramifications of next generation sequencing, DNA sequencing, RNA sequencing, combined with artificial intelligence and CRISPR gene editing and other gene therapies. That troika is going to transform healthcare completely. And I don't think that many traditional analysts out there believe that we are on the threshold of curing many diseases. We do believe that. And I'd like to take you just through a few examples. I mentioned last week that Illumina and Twist in the sequencing space, so Illumina reading DNA sequences, reading, Twist, writing DNA sequences. These two companies are the reasons why Abbott and Cepheid were able to come up with tests so rapidly. So their technology is PCR technology is very old technology, but these tests were very useful in getting us going here in the United States and throughout the world in getting some answers. So we think that the heart and soul, the starting point, is next generation sequencing. To give you a sense of how provocative this is going to become, the use of sequencing and artificial intelligence, Grail put out a study, a research study, and they collaborated with many, many scientists and researchers around the world. It's the most comprehensive study of all cancers in the world and ever. And the most provocative outcome, what hit me in terms of the possibilities, had to do with pancreatic cancer. Now, based on our studies, and unfortunately, many people have lost family members to pancreatic cancer, and all too often what will happen is the cancer will be found, oncologists will find the cancer in stage 4, already metastasized. So they find it, and before a patient can receive his or her first therapy, very often that patient has died. That's how lethal the cancer is, at least at the time we find it. Grail's study shows that because of liquid biopsies taken from the blood, studying fragments from the tumor, because of liquid biopsies, and something called methylation, which is a pretty new field of study, that we are going to be able to identify pancreatic cancer. They did in this study in stage 1, 65% of the time. Stage 1, that's when we can do something about it. And with machine learning and artificial intelligence, that percentage is going to go up over time. And ultimately, if we're right with the third leg of this stool, gene editing, gene therapies, and also immunotherapy, we will be able to cure that cancer. So it's very exciting. I remember reading stories about people with pancreatic cancer, and they just had no hope because they didn't know they had it until it had metastasized, and it was way too late. Now already we're seeing hope, and the numbers are going to get better because of artificial intelligence. So that's very exciting. The other exciting outcome of the turmoil of the last month is that now legislatures are going to be much more friendly to, as I mentioned last week, both vaccines, and I gave you some of the names that we have been researching. So Moderna, Inovio, Arcturus. And we also think they're going to be much more friendly, and insurance companies are going to be much more willing to reimburse for tests. They don't want to be blamed for our inability to identify a disease. And that too is getting better with, again, artificial intelligence. We know that in vitae, in germline, and soon somatic studies, tests, is using artificial intelligence, as is Guardant in the liquid biopsy space, again, focused primarily on cancer. So we think companies like that are going to be greeted by a much more friendly reimbursement regime as time goes on. And also Veracyte, I forgot to mention, that one just reported last night. And they have been hit because a lot of business has been stalled by hospitals being occupied elsewhere. But Veracyte's another name we would put in that camp. And as I mentioned, gene editing, the thought that we can actually, because we understand where and what the mutations are, we're going to be able to then edit out those mutations, sort of like a computer program. There's a programming error, you edit it out to correct the problem. In this case, there's a mutation, which is a programming error, and you edit it out. So we think that we're going to see in the first half of this year, maybe stalled a little bit. CRISPR Therapeutics certainly has said it's unable to conduct some of its trials because they don't want their patients to be going to hospitals during this time. So there will be some delays, but this year we're going to see the results of human trials. We've seen the early glimpse in terms of beta thalassemia and sickle cell disease. CRISPR has shown a cure for both of those just in 2 patients, very early days, but very earliest days of human trials, and such hope. And then finally, I think what this time period is going to galvanize is a move into telemedicine. So Teladoc has done very well through all of the turmoil here. And now that Medicare has said, yes, telemedicine, we do not want the elderly people out there in harm's way as the coronavirus has been raging through and hurting specifically that population. If Medicare has bought into something like this, well, we think it's going to be pretty ubiquitous, much faster than otherwise would have been the case. So that is the area of the market that we think is the most inefficiently priced, certainly from a long-term point of view. As you know, our investment time horizon is 5 years, and our minimum hurdle rate of return over a 5-year period is 15%. Most of our strategies are showing revenue growth north of 25%. So we think that's fairly conservative. But we do believe, because of the way research is set up in traditional asset management firms, it's not broken out by innovation platform, and it's not as collaborative as it needs to be among these various technologies, that healthcare, and specifically genomics, is one of the most inefficiently priced parts of the market. So with that, now that we're 2 weeks through, in terms of consecutive increases in the equity markets, I don't know how much longer I'm going to be doing this particular video, but we're here for you. That's why we're doing this. And if I need to be here next week, I certainly will be. Our entire firm has been focused on reaching out and over-communicating. So please go to our website, ark-invest.com, if you want to read more about what we're thinking. And of course, we're on Twitter as well. So again, I hope you have a lovely weekend. It's spring, there's hope, and maybe I'll see you again next week. Maybe I won't. So thank you. Bye-bye.